It was a week that reminded investors how quickly sentiment can change. Geopolitical tensions surged, oil prices exploded higher, and markets around the world pulled back. But when the headlines get loud, it's usually the underlying economic data that tells the real story. Welcome to Beyond the Benchmark, where we break down the economic data and market trends shaping investor decisions. I'm Ryan Kasper, and this is your weekly IPC Short, our quick update from the LSA Investment Policy Committee highlighting what moved markets this week and what investors should be watching next. It was a volatile week across global markets as investors navigated a mix of economic data and escalating geopolitical tensions. On the economic front, the data painted a somewhat mixed picture. Manufacturing and services surveys both showed improvement, suggesting that parts of the U.S. economy continue to expand at a healthy pace. However, retail sales were largely flat, and the February employment report disappointed expectations. Several of these numbers were influenced by temporary factors, including severe winter weather and other one-off disruptions, but they still added to the uncertainty investors are currently processing. Retail sales for January declined slightly by 0.2%, which was actually a bit better than economists had expected. When stripping out the more volatile components, core retail sales rose 0.3%, matching expectations. Some of the weakness appeared concentrated in areas likely impacted by winter conditions, including sporting goods, clothing, and autos. On a year-over-year basis, retail sales are up about 3.2%, which roughly matches inflation and suggests real consumer spending growth remains fairly modest. Business activity surveys were more encouraging. The ISM Manufacturing Index remained in expansion territory at 52.4, beating expectations and signaling continued improvement in the industrial side of the economy. Meanwhile, the services sector showed even stronger momentum, with the ISM Services Index rising to 56.1, its highest level in more than 3 years. New orders and business activity both improved meaningfully, reinforcing the idea that much of the U.S. economy remains resilient despite pockets of weakness. The labor market report, however, was the biggest surprise of the week. Non-farm payrolls declined by 92,000 in February, well below expectations for modest job growth. Some of this decline was tied to temporary factors, including a healthcare strike and weather disruptions, but it still pushed the unemployment rate slightly higher to 4.4%. Wage growth remained solid, with average hourly earnings rising 3.8% over the past year, while productivity data continues to run stronger than pre-pandemic trends, which remains an encouraging longer-term signal for economic efficiency. Markets reacted strongly to geopolitical developments in the Middle East. Military actions involving the United States, Israel, and Iran escalated early in the week, raising concerns about potential disruptions to global energy supply, particularly through the Strait of Hormuz, one of the world's most critical shipping routes for oil and natural gas. While U.S. equities held up somewhat better than international markets, stocks broadly moved lower. For the week, the S&P 500 fell roughly 2%, while developed international and emerging markets declined closer to 6 to 7%. Energy was the one area that benefited from the situation. Oil prices experienced one of the largest weekly increases in decades, with West Texas crude jumping roughly 35% to around $91 per barrel. This surge in energy prices also pushed bond yields higher as investors reassessed inflation risks, resulting in modest declines across the bond market as Treasury yields moved higher. The key questions investors are now watching revolve around the potential economic impact of the conflict. How much disruption might occur to regional energy infrastructure? How long could the conflict last? And what might the longer-term geopolitical landscape look like once tensions eventually settle? As always, we continue to monitor these developments closely through the Investment Policy Committee process, focusing on diversification, disciplined portfolio construction, and maintaining a long-term perspective even during periods of short-term volatility. Thanks for listening to Beyond the Benchmark. We'll see you next week with another IPC Short.